Okay, in today's video, I am going to show you guys how I generate money using options. Spoiler, it's pretty cool and pretty easy, in my opinion. So let's first start with a background on how I even got into all of this. Basically, I was pretty bored during pandemic time, running low on freelance photography, videography jobs, so I dove into the world of YouTube and started doing research. Now, most of us are familiar with stocks and stock trading, and a select few of those stock traders are familiar with what options are. Now, I've always heard about options, like I've heard about that term, but I never actually knew what it was. So then I started doing some research. So what is an option? If you do a Google search or a few YouTube videos, it's basically gonna tell you that an option gives you the right to control 100 shares of an underlying stock. So Tesla. If you own an option on Tesla, you own the right to control 100 shares of Tesla. I know that's a little confusing at first, but it gets easier and I'll try to make it simple. So with options, there are two types of options. There is a call option or a put option. Call options are when you think the stock is gonna go up, and put options are when you think the stock's gonna go down. But that's just the bare minimum of it. It can also be vice versa, and I will explain. All right, so now we have our calls and our puts. Now, breaking that down even further, you can either buy a call option or sell a call option. You can buy a put or sell a put. When you buy a call option, you are thinking the stock is gonna go up. You buy low, and then you're gonna sell that option when the stock price goes up. Buy low, sell high. That's pretty much the standard rule for buying normal stocks. You try to buy it at a low, and then you sell it at a high. Same thing with buying a call option. Now, you can sell a call option, or you can sell a covered call. That's what it's really known as. So basically, if you sell a call option, you already own 100 shares of the stock. So how do you sell a call option? Well, you really only sell a call option when you already own 100 shares of a stock. Once you own 100 shares of a stock, you can sell a covered call. Covered meaning you have the 100 shares already, so it's covered. Now, why would you do this? Well, let's say you own 100 shares of Apple and you want that 100 shares to start making you money. You can think of it as an asset, because once you own 100 shares of it, you're eligible to start selling covered calls. And when you sell a covered call on it, basically you're saying that if Apple's stock price jumps above a certain price by a certain expiration date, then you will sell all 100 shares of your Apple stock at that price. It's basically an if-then statement. If it hits this stock price, then I will sell 100 shares of it. What are the pros and cons of this? The pros are, once you sell a covered call option, you instantly pocket the premium of that contract. I understand that all this is going to be weird to follow without any demonstration, so I'll jump into my stock trading brokerages to show you, because once you see it, it makes more sense. So let's move on to puts. When you buy a put option, you think the stock's going to go down, and if it does, you profit. But when you sell a put option, it's more of a bullish strategy. You think it's going to go up, and you actually don't want the stock price to go down too much, but if it does, you're still happy with it. The other terms you need to know, if you're not already familiar with them, is bullish and bearish. Bullish means you think the stock is going to go up, you think everything's going to be green. We're in a bull market, so everything's going up. Bearish, complete opposite. You think it's all going down, it's red, everybody's losing money, it's the end of the world, yada, yada, yada. Now we got that covered. So quick recap, there's two types of options: calls and puts. You can do two things with options. You can buy them or you can sell them. When you buy any option, you try to buy low and then sell high. When you sell an option, you collect a premium for it in exchange for putting up some type of collateral. Just realized I didn't go over selling cash secured puts, but we will do that. Just wait. So in my experience, I have actually done all four of these methods and have succeeded in my own way with each of them. So I'm pretty happy about that. So let's show you how it's done. I use two stock brokerages. I use TD Ameritrade, Thinkorswim, same thing, and I use Robinhood. A lot of people hate Robinhood. I'm not the biggest fan. I had some money in it, and there's commission-free trading, so I have a smaller percentage of my portfolio in Robinhood, and the majority of my money is in TD Ameritrade. Once you start selling a lot of options, those commissions do tend to add up. It's only 65 cents per option contract, but you multiply that by enough numbers, and it will be a lot. Let's start this screen recording, if I remember how to do that. And it is recording. Check, check, check. Okay, here we are on my TD Ameritrade Thinkorswim. This is the web version if you guys are confused by the interface. There's a standalone application for Mac and Windows, which is a good interface to use, but there's a lot of tools and it's a little just too much, to me at least, to professionals. They're going to love it. This is a very simplified version, and I think it's easier to follow, and I use it every day. This is the web version, if anybody's asking. So I am currently in a trade with Blink right now. Ticker symbol BLNK. I own 100 shares. Actually, I own 200 shares of Blink. As you can see right now, it's at $35.26. So technically, I'm at a loss. But since I own 200 shares of Blink, I'm eligible to sell covered calls on it. I could sell 2 covered call contracts on Blink right now and collect a premium. What I would do is I would go to the option chain. July 9th is tomorrow, so the premiums or the amount of money that you're going to make for selling these contracts are going to be pretty worthless, so there's no point. So if we look at July 16th, which is next week, next Friday. So this is the option chain for Friday, July 16th, which is next week. On the left will be all the calls. You can see that right here. On the right are all the puts. And then, as you see, there's two options. You can sell them or you can buy them. Sell, buy. A bid is a sell. Think of eBay. It's a bidding war. So you're selling the option. Ask is a buy. How much do you want for it? I'm asking you, how much can I pay for this? Yeah, does that make sense? Ask, buy. It took me a little to remember that, but once you see it every day, you're gonna remember it. Most trading brokerages will have a similar layout. They'll show you the gray highlighted shows in the money, which just means that any of these options in here are in the money, meaning they're underneath the strike price. Out of the money just means they're above the strike price. And the strike price is everything here in the middle. And the underlying price or the underlying stock's price, that just means whatever the stock is and whatever its current price is at the time. So as you can see, the underlying stock is at $35.20, and right here, $35 in the middle. 35 is in the money, 35.50 is out of the money. So when you're selling a covered call, you would try to go out of the money. Let's just say I own 100 shares of Blink at $40. And if I were to sell this $37 strike price contract, I would make 94 cents by selling it. 94 cents times 100. Because remember, an option lets you control 100 shares of a stock. 100 times 94 is $94. If I were to sell this contract right now, I would pocket $94. That's pretty cool, right? Now that's the pro of this. Cool, I make money just because I own the stock. It's an asset, it's making me money. What's the downside? Well, I'm selling the 37 strike. So what that means is if come July 16th, by 4 p.m., the stock market closes and Blink is above $37. Let's say it's at $40. I am forced to sell 100 shares of my stock at $37 instead of the $40 that it's currently at, meaning I'm losing out on $300 of unrealized gains. Plus, I bought it at $40. So if I'm selling at $37, I'm taking a loss of like $300. That sucks, right? You need to know when to do these trades, and it has to make sense. So the closer in the money or closer to the money you are, the higher the premium is going to be. Like you can see right here, $1.46, you're going to make $146 by selling it at $35.50, but it's only like 40 cents away from $35.50. So basically how people figure out when to trade is by doing their due diligence, their technical analysis, yada, yada, yada. Anything they can do to help them make an educated guess. I'll be honest, I don't do any of that. And sometimes I pay for it. Other times, it works out in my favor. This probably isn't the best advice to give, but I would sell it at a price I'm comfortable with if I were to lose it. So you could go out to $40. I could sell it at the $40 strike price and make $35. And in the case that it were to end above $40 by expiration, then boom, I would have broken even basically. But I've been selling covered calls on this for the amount of time I've owned it. So I've been collecting premium on it, making a little passive income every week. You can sell covered calls closer to the money and make a higher premium. You can be safe, conservative, and sell it out of the money closer to whatever you bought it at so that you're always going to profit. Hopefully that made sense. Let's move on to just buying a call option. Actually, this morning I bought 10 contracts of Blink that expire in 43 days. So a month. I spent $5,950 on them. This morning, everything was red, everything was dipping, so I thought, hey, might as well buy it now. I'm pretty sure it'll pop up a little bit in 30 days, right? And I was right because, I mean, already you can see a $600 gain. Not bad. $600 profit already off a almost $6,000 investment. That's a 10% gain in half a day. If I wanted to, since I bought this, I can sell it. I can close this right now and sell it, and I would profit $6,443.31. Now remember, I paid about $5,950, so do the math. It's a pretty easy profit for literally no work except putting money down, right? That is the scenario of how you would make money by buying a call option. So hopefully that made sense as far as the whole call side. Let's move to the put side and how you can make money doing puts. So what did I do? A while back, I did a trade on Clove, and I guess it's gone. But basically what I did was I bought a put option on Clove because this stock, if you guys were following it at all, it went up to $27 out of like a crazy Reddit frenzy. To me, I was like, there's no way it could stay above $27. Like just looking at this chart, it's from $7 all the way to $27. That's 3 months out. If we go 6 months out, I mean, at the high, I was at 15. And yeah, just this didn't seem sustainable, so I figured it's got to drop back down, right? So I think I bought a put around $20-ish range, and then basically whenever it dropped below $12, I was profiting. The put option contract cost about $6,000, and then I sold it around $11. Yeah, so somewhere around here, probably around June 22nd. Yeah. So basically, I saw it dropping. I was like, oh, I'm in the green. This is my first time buying a put option. So I had a feeling it would go down more. I just want to be safe because I messed up before with another option that I'll tell you about another day. But I just want to take my profits and be happy with it. And I am happy that I did it. I bought that put option for 90 days out, which is why it was so expensive. So I was safe for, like, if I sold it today, I would have made a lot more money. I probably would have made $2,000 or $3,000. When I sold it here around 11, I made about $1,500. $1,500 profit off of like a $7,000 investment. I was cool with it. That is the scenario of how you make money by buying a put option. You think the stock's going to go down and you capitalize on it. I got nothing against the stock. I just saw an opportunity that made sense. Now, how do you make money selling puts? So when you sell a put, it's called selling a cash secured put. Basically what that means is that you have the money or collateral available that you put aside in the case that the stock drops below a certain price, and then you have to buy 100 shares of the stock. Let's run through it just so we can see what that looks like. We'll play with BlackBerry because that's a pretty fun Reddit stock right now that everyone's looking at. If we were to look at July 16th, this is next week, today's July 8th, we can look on the put side, and right here, we can go to the bid, which is the sell, and the stock's at $11.50 right now. Let's look at the $11 strike. We can see that it's 28 cents for selling this $11 strike contract. If I were to click on it, I can review. Let's make this easier and just do one contract. One contract. By putting up $1,100 right now for next week, you can make $27.34. If BlackBerry drops below $11 by July 16th, 4 p.m., when the stock market closes, you'll have to buy 100 shares of BlackBerry at $11. But the way you should look at this is you shouldn't be sad if that happens, or mad, because you're the one that chose that strike price, right? If you're mad that you have to buy it, then you're doing it wrong because you chose the wrong strike price, because you got greedy and you want a high premium. Also, you only sell cash secured puts on stocks that you want to own for the long term. You're basically saying, hey, I'll buy it if it drops below this price. That's all that's going on right now. What people do is they pick stocks with higher premiums, and those stocks are usually high volatility stocks like Tesla or any of these Reddit stocks. There's websites that tell you which stocks are currently like very volatile. You can look at it like that. I was doing this a lot in the beginning on stocks that I just want to own, like Blink. I like Tesla. I like Blink. I like EV stocks, like all that stuff. But then I saw that you can make more money by buying call options and selling them, or selling poor man covered calls on them. That's a whole nother video. If you want to see that video on what a poor man's covered call is, comment down below and I'll try my best to explain it. But yeah, that's a cash secured put. You need the money available as collateral to sell a put option to make the premium immediately. So selling cash secured puts is usually a bullish strategy because you don't want the stock to drop below your strike price because you think it's going to keep going up. But if it does drop below your strike, you're okay with buying it. All right. So in conclusion, there are many strategies out there regarding options trading. I barely scratched the surface. There's still iron butterflies, iron condors, spreads, naked puts, naked shorts. There's a lot. And I've figured out what I like to do. Research their due diligence, research options trading, play around with it, see what works best for you, and then start making some money. And probably lose a lot of money if we're being honest. I lost a few, but I made it back, and everything's been pretty good so far. Originally, I loved the wheel strategy, which was selling a cash secured put on a stock. If you got assigned, then you own 100 shares of that stock, and then you would just start selling covered calls on it. And then once that gets called away from you, you just repeat the process. It's pretty cool. And I still do it today, just not as much. Now I really like buying leaps and call options and selling poor man covered calls on them. And I can make another video about that in the future if you'd like. You just gotta comment down below and ask me nicely. Well, I think that's all I got for you. So if this video helped you out, would really appreciate it if you liked it. Comment anything down below. Subscribe for the journey. And if you got any questions or new video ideas or corrections, because I might have royally messed something up in this video, please let me know down below. And with that being said, I will see you next time.